Okay, so let's get started today with the accounting basics. Yeah. Okay, so basically when we talk about accounts, we can define to say accounts or accounting is the recording of financial transactions. Okay, accounting is the recording of financial transactions. We have two types of transactions. Two types of transactions. We talk about one, cash transaction. Two, credit transaction. Don't worry about the notes. I'll send the full notes. I'm just trying to explain. Credit transaction. So a cash transaction this is a transaction where a sale or purchase is made, but a payment or receipt is made later. Okay, so a sale or purchase may be made today, but the payment or the receipt of money will be made on a later date. Normally, companies use 30 days. 30 days, but depends on the agreement. Some may use 30, may use 90 days or any other days. Depends on the agreement. Okay, then a credit transaction. A credit transaction. This is where a sale or purchase is made but the payment or receipt is made later. Okay, so sorry, I swapped. With a cash transaction, a payment or receipt will be made immediately. Is made immediately. I hope you get the concept. Just by the term cash transaction, this involves the receipt or payment of money immediately a transaction is done. So if you sell something today, that means you're going to receive the cash today. If you buy something today, that means you make the payment today. Okay, that's a cash transaction. And then the opposite is just the cash transaction. I'm trying to be quick to reduce my video. It's almost 4 minutes here. Okay. Okay, let's dive into something more meaningful in accounting so that we move away from the basics. We concentrate more on something detailed, as most of you clients were sending the topics which want to be covered, and that's my focus. Okay, so in accounting, basically we talk about the accounting cycle. Okay, accounting cycle or accounting system. I'm going to draw a circle to show what's involved in accounting or things that we'll be dealing with in our course for accounts. So basically, it's a circle, accounting circle. I hope it's visible enough. So the first thing we deal with in accounts is the source documents. These source documents provide evidence for a transaction that took place. Okay, we'll talk more about source documents, but in case you need an example, these are just documents like a receipt, an invoice, a credit note, a debit note. These they provide evidence. Because in accounting, we don't believe in verbally just saying, no, I spent this much, I bought this. No. Okay. Our bosses or any department, they will require evidence for a transaction for them to be sure it took place and for the documentation and the accounting system to take place. So source document is number one in our accounting system. Then we come to books of prime entry. Books of prime entry. Books of prime entry or books of original entry. You can use either name of that to be correct. Books of original entry will be second. So from source documents, you record the transaction in these books of prime entry or books of original entry. From these books, that's why we have the ledger. The ledger book, this is regarded as the principal book for accounting, because this is where the double entry is achieved. In the books of prime entry, you just record a transaction as well, just to say this transaction took place on this day. But in the ledger, this is the part where we'll do the double entry, and this is the principal book of accounting. This is the book where the accounting has to be done in a right way. Okay, it's the accounting book, it's the principal book, the main book. And then after the ledger, we have the trial balance. Trial balance. The trial balance, this is not a book. It's just a document or a sheet which details the books found in the ledger to test the accuracy of double entry. The double entry that we've been doing throughout the year, you need to prepare the trial balance to test the accuracy of the double entry. If your double entry was correct, the trial balance is supposed to balance. As in the debit and the credit columns, they have to balance. If it doesn't balance, it means there's an error in the way you were doing things, in the way you were recording your transactions. Even though you find an error, there's a way we correct, and that's where the suspense account comes in. So we'll talk more about that. And finally, in every financial year, an accountant or anybody handling the books of accounts, they need to prepare the financial statements. These are also just documents or reports rather that an accountant prepares to detail or to give the status of the running of the business in that financial year. Okay, the financial year is a period in which the company was doing business. Normally it's a year, but it depends on whatever date the company uses as a financial year. So you may use 1st January to 31st December as your financial year or as your accounting year, or you may choose any other date according to what you prefer as a company. So at the end of the financial year, that's when these financial statements will be prepared. So financial statements, I'm talking about the income statement, or the statement of financial position. Statement of financial position. Okay, so all of this, my circle, though it looks ugly, but for explanation purposes, I'm sure you're able to follow through. Okay, these are the main things or the only things we're dealing in accounts at whatever level, be it in grade 12 or in the course. We normally talk about this. So anything expansion, any additions come from this, but you must bear in mind that accounts deals with these things, but different items are introduced depending on the level that we are doing our accounting. Okay, hopefully I'm trying to explain and doing my level best, and I hope you are following through. After this video, I'll be expecting your expectations, so you tell me where you missed it, but bear in mind this is just for explanation purpose. I have the full notes I'll be sending in PDF where you need to print, and if I give an assessment, I also need you to do it and scan and send back. Okay, so I just want to explain a little bit more on the source documents. Okay, source documents being our number one thing in the accounting circle. Source documents. I'll give examples and then we'll talk more about this. We have an invoice. Invoice. This is just a document providing evidence in the books of accounting. So an invoice can be a sales or purchase invoice. Okay, or purchase invoice for goods sold on credit, goods sold on credit, goods sold on credit, or goods bought on credit. Goods bought on credit. Okay, so this is where we were talking about the credit transaction. So when you sell on a later date or on the actual date, you can send the invoice to your customers, or the suppliers will send an invoice to you saying this is the amount we are expecting from the transaction that we did. We are expecting this payment, or we are expecting to receive this amount. Okay, so that's about an invoice. And then what else I need to explain? We have the credit or debit note rather. Let's start with the debit note. This is also a document which a customer sends to a supplier, sent by a customer to the supplier, asking the supplier to reduce the items bought on credit which are returned back to the supplier. Returned back to the supplier. So we're talking about 40 goods. You buy something and then you notice there are 40. So you pack all those 40 goods and then you send them back to the supplier. The supplier will read the debit note and they will say, okay, this customer is asking for a reduction from the goods that they bought at that time we transacted. So after the supplier recognizes your debit notes, they will need to send you now the credit note. Basically, people get confused over these terms, but that's the difference. A document sent by the supplier to its customers. Okay, I think I've done my best to explain on that. Let me quickly run to the final segment so that I'll be done with the introduction, and then later we'll focus on our main major things. Okay, so explaining the final part for today. Okay, so when you sell goods, when you sell goods on credit, your customers, you call them receivables. And these go into the books we are calling, or the accounting book we are calling the receivables account. Okay, and then when you purchase something on credit, you buy. This time it's you buying. You purchase something on credit. Your suppliers will be called payables. So you record that transaction in your payables account. Okay. Payables account. I hope those terms, they're not confusing. They're not, so explain more. Okay. And then finally, let me talk about the books of prime entry. Examples. Prime entry. So remember, these books of prime entry, they don't involve anything to do with double entry. It's just you recording, maybe in column form where you say date, details, invoice number, folio. We'll talk much about all these things later. Folio, amount, stuff like that. Okay, amount. So that's what will be contained, or that's what will be consisted on in your books of prime entry. So you see, it's just columns, nothing like double entry. This goes to the debit or credit, nothing in these books. They are just books of prime entry, books of original entry. After the source documents the same transaction amount is the same amount and details that comes to this box of entry. Okay. So now I'm interested in mentioning a few examples of these same books. Okay, so examples we'll talk about, let's say, number one, sales day book or sales journal. Sales journal for goods sold on credit. For goods sold on credit, and then two, sales returns journal. Sales returns journal or returns inwards journal, one and the same. Sales returns journal or returns inwards journal. So you sell, you record in the sales returns in the sales day book. Then if they return, your customers return, that's when this book will handle. It's also a book of prime entry. Okay, the sales returns journal or returns inwards journal, one and the same. Three, you have the purchases day book or returns outwards journal. Okay, so you buy from your suppliers, you record that transaction in this purchases day book or purchases journal, that's another name, journal, or the returns outwards journal. The returns outwards journal will handle the returns, okay? It's another book of prime entry. So let's put it at number 4. Returns outwards journal. I'm rushing, so somehow I'm confusing things, but my final statements are my true explanations. Okay, so returns outwards journal will handle the purchases day book or purchases journal. When you buy things, the purchases day book will handle that transaction. The other name for the purchases day book is purchases journal. Then if you return something yourself, you return something, you record that transaction in the returns outwards journal. Okay, returns outwards journal 4, and then we'll have a lot more, going about 5 or 6. Okay, now I'm trying to restrict my video. It's 23 minutes. I didn't want it to go above 20 for the sake of convenience and the bundles on the WhatsApp. Okay, I hope you understood my explanation. If it wasn't too clear, you can still drop the comment and ask me. Then I'll give an explanation. But I have the notes over this, very well summarized notes, which you will enjoy. Okay, so this is prepared for Success Knowledge Center. For the people doing accounts, these are general basics, grade 12, even at college level. These are the same things which work. Okay, and then I expect you guys to go through this video within 24 hours, because if you don't go through within 24, it means when I post the next one, you'll be behind. I believe 24 hours is big. If you're busy in the morning, you can go through in the evening. Just make sure it's 24 hours. I'll be counting from the time of posting, 24 hours, then I should be preparing the next. Thank you so much. It's been Moses Piri. Hopefully you enjoy.